Right now, while most people are distracted, while the noise of the world gets louder, something silent, powerful, and life-changing is unfolding beneath the surface of the global financial system. And if you miss this moment, history will not repeat it for you. It will simply move on without you. $10,000 silver isn't a fantasy headline. It's a warning signal. A signal for those who are awake. A signal for those willing to think differently, act differently, and build a future instead of hoping for one. I want you to take a breath and listen carefully, because this is not about panic. This is about preparation. It's not about fear. It's about clarity. Every major shift in wealth has arrived quietly, long before the crowd realized what was happening. By the time everyone agrees, the opportunity is already gone. There was a time when gold was confiscated, currencies collapsed, and empires fell, not because people were evil, but because people trusted systems that were already broken. Robert Kiyosaki has warned again and again that fake money creates fake security, and fake security creates real poverty. Most people work harder every year, yet feel poorer every month. That's not an accident. That's a design flaw in the system. Think about this. You can work your entire life, save numbers on a screen, and still end up with nothing when inflation silently erodes your purchasing power. That's why the richest investors in history didn't chase paper promises. They accumulated real assets. Assets you can't print. Assets you can't fake. Assets that survive chaos. Silver has always been the money of the people. Gold is held by central banks. Silver is held by those who understand cycles. And right now, silver is being consumed, not just stored. It's used in technology, energy, medicine, and the infrastructure of the future. Every solar panel, every electric vehicle, every advanced circuit quietly pulls silver out of the ground and never returns it. Supply shrinks while demand explodes. That's not hype. That's math. Here's the mindset shift most people miss. Wealth doesn't reward effort alone. It rewards positioning. You don't need to predict the future perfectly. You need to stand in the right place when the tide turns. The investors who changed their bloodlines didn't wait for confirmation. They waited for conviction. Look at history's greatest wealth builders. They didn't buy assets when everyone felt comfortable. They bought when the headlines screamed fear and confusion. They understood that volatility is not danger. It's opportunity wearing a disguise. While others panic, they prepare. While others consume, they accumulate. And this applies far beyond money. In life, growth always demands discomfort. The moment you stop chasing approval and start chasing understanding, your world expands. You begin to see how patience beats speed, how consistency beats intensity, and how calm thinking beats emotional reaction. Silver teaches this lesson perfectly. It doesn't move loudly at first. It moves slowly, then suddenly, just like real success. Ask yourself honestly, are you building something real or just renting comfort? Are you trading your time for paper or converting effort into assets? Every paycheck is a decision. Every expense is a vote. Every delay is a cost you may never recover. There's a reason people like Kiyosaki emphasize financial education over financial prediction. When you understand money, you stop fearing crashes. You start preparing for them. You diversify, not because you're scared, but because you're disciplined. You don't chase prices. You build positions. You don't bet everything. You stack intelligently. This is where action matters. Start thinking like an owner, not a consumer. Reduce dependence on debt that drains you. Build cash flow where possible. Convert excess income into assets that protect purchasing power. Learn the difference between price and value. And most importantly, stop waiting for permission to secure your future. The greatest tragedy is not failure. It's regret. It's realizing too late that the signs were clear, the warnings were loud, and the opportunity was real, but comfort kept you still. You don't need to be rich to think like the rich. You need courage, patience, and education. Imagine looking back years from now, knowing you acted while others hesitated, knowing you didn't panic, you prepared, knowing that while the system shifted, you stood on solid ground. That confidence doesn't come from luck. It comes from intentional choices made early, quietly, consistently. This is bigger than silver. This is about reclaiming control over your life, about stepping out of the herd and into awareness, about realizing that true security doesn't come from promises. It comes from ownership, knowledge, and discipline. $10,000 silver is not hype, not a fantasy headline designed to shock, and not a promise of instant riches. It is a signal, a quiet warning that the monetary system most people trust without question is fracturing beneath the surface. Throughout history, money has always changed its form when confidence disappears. Empires didn't collapse overnight. They eroded slowly while citizens continued daily life, unaware that the rules were shifting. The signs were always there: excessive debt, endless currency creation, shrinking purchasing power, and a growing gap between effort and reward. Today, those same signals are flashing again, louder than ever, yet disguised as normality. When governments print money faster than value is created, they dilute the work, time, and savings of ordinary people. Inflation isn't an accident. It's a hidden tax paid by those who hold paper promises too long. This is why silver matters. not because of price targets, but because of what it represents. Silver is real, tangible, limited, and historically recognized as money across civilizations. It cannot be created with keystrokes. It requires energy, labor, and time to extract. That alone separates it from fiat currencies built on trust rather than substance. What makes this moment different is that silver is no longer just money. It is a critical resource. Modern technology consumes silver permanently. Solar energy, electronics, medical equipment, and advanced infrastructure all rely on it. Unlike gold, much of this silver is never recovered. Supply tightens quietly while demand expands relentlessly, creating pressure that doesn't announce itself until it's too late for the unprepared. Markets don't move when everyone understands the story. They move when reality collides with denial. Smart investors don't wait for headlines to turn positive. They listen for signals beneath the noise. When respected voices warn about currency debasement and systemic risk, they are not predicting dates. They are highlighting trends. Wealth shifts don't reward speed, they reward awareness. Silver's potential rise reflects not greed, but a loss of confidence in paper systems that promise stability while delivering erosion. This is why silver at extreme valuations isn't about speculation. It's about survival of purchasing power. Those who understand this don't chase price. They accumulate protection. They see silver not as a trade, but as insurance against financial instability, a bridge between the old system and whatever replaces it. While most people focus on numbers on a screen, the quiet transfer of value continues underneath, reshaping futures, redefining security, and separating those who prepared early from those who trusted too long. If this message resonated with you, if it challenged the way you think about money, life, and the future, then stay connected. Like this video, subscribe to the channel, and share it with someone who needs to hear it before it's too late. Because the next chapter of wealth will not be announced loudly, but those who are listening now will be ready when it arrives. Real wealth has never been built by waiting for permission or confirmation from the crowd. It has always been created by those willing to stand alone before the outcome becomes obvious. Positioning early is not about guessing perfectly, it is about recognizing patterns before they are accepted as truth. By the time an opportunity feels safe, it is usually expensive, crowded, and stripped of its greatest potential. The majority waits for certainty, not realizing that certainty only appears after the reward has already been claimed by those who acted with conviction. History makes this painfully clear. The biggest fortunes were not built at the top, when headlines were optimistic and confidence was high, but during periods of confusion, skepticism, and disbelief. When new technologies emerged, when markets crashed, when systems were questioned, early movers quietly accumulated while others hesitated. They didn't have superior information. They had superior perspective. They understood that markets are driven not just by numbers, but by human psychology. Fear delays action, and comfort destroys opportunity. Positioning early requires emotional discipline. It means tolerating doubt while others laugh, criticize, or ignore what you're doing. It means acting without applause. Most people are trained to seek validation before making decisions, especially financial ones. They want reassurance from experts, friends, or media before committing, but validation always arrives late. By the time the crowd agrees, risk has already transformed into reward and entry becomes costly. This principle applies far beyond investing. In life, careers, and personal growth, those who move first shape the landscape. Entrepreneurs who waited for perfect conditions never built anything lasting. Individuals who waited until confidence appeared never left their comfort zones. Confidence is not a prerequisite for action. It is a result of it. Early positioning forces growth, clarity, and resilience because it demands responsibility for outcomes rather than excuses. Smart positioning is not reckless. It is calculated patience combined with research, learning, and awareness. It is understanding macro trends instead of chasing short-term excitement. It is building exposure gradually while time does the heavy lifting. Early movers don't go all in emotionally. They stay grounded, flexible, and informed. They know that time rewards those who align with long-term forces rather than daily noise. The crowd reacts to price. Disciplined investors react to value. The crowd asks, is it safe now? While early movers ask, does this make sense over the next decade? This difference in thinking separates participation from leadership. Wealth follows leadership. Those who position early aren't lucky. They are simply willing to act before comfort arrives, before certainty forms, before the story becomes popular, while opportunity still whispers instead of shouts. Paper money gives the appearance of stability while quietly losing its substance, creating a sense of security that feels real until it suddenly isn't. Numbers on a screen look permanent, but their value depends entirely on trust. Trust in governments, trust in policy, trust that tomorrow will resemble yesterday. History shows that this trust has always been temporary. Every fiat currency ever created has followed the same path: introduction, expansion, overuse, and eventual decline. The process is slow enough to feel normal, which is why most people never notice the danger until purchasing power has already been drained. The illusion works because paper money is convenient. It allows people to store effort digitally, transact instantly, and plan for the future without thinking about what actually backs their savings. But convenience often hides cost. When currencies are created without restraint, they dilute existing value. Each new unit makes previous units worth slightly less. This erosion doesn't arrive as a sudden collapse. It arrives quietly through higher prices, shrinking buying power, and the feeling of working harder just to stand still. Real assets operate differently. They do not depend on policy decisions or political promises. Their value comes from scarcity, utility, and human demand. Land cannot be printed. Metals cannot be fabricated out of nothing. Energy, labor, and time are required to produce them. That inherent cost creates a natural floor of value that paper systems lack. When uncertainty rises, capital flows toward what is tangible because tangibility restores confidence. This is why real assets have survived every monetary reset in history. When currencies failed, ownership did not. Those who held assets weren't immune to volatility, but they retained optionality. They could trade, rebuild, and adapt. Those who held only promises had to start over. The difference was not intelligence, but structure. One side stored value in systems, the other stored value in reality. Modern financial education rarely emphasizes this distinction. People are taught how to earn money, not how to preserve it. They are trained to save numbers, not to question what those numbers represent. Over time, this creates dependence on institutions rather than understanding. When stress enters the system, dependence becomes vulnerability. Real assets don't eliminate risk, they transform it. Instead of relying on trust, you rely on fundamentals. Instead of hoping policies remain favorable, you align with physical constraints that cannot be negotiated away. This shift in thinking changes behavior. Spending becomes intentional. Accumulation becomes strategic. Wealth stops being about accumulation of currency and starts becoming about protection of purchasing power, stability across cycles, and independence from systems designed to benefit those closest to the source of money creation. Silver occupies a rare position in the world of assets because it exists simultaneously as money and as an essential industrial resource. And this dual role creates pressure that most people underestimate. For thousands of years, silver functioned as a medium of exchange, a store of value trusted across cultures and borders. Long before modern banking systems existed, silver carried purchasing power because it was scarce, divisible, and universally accepted. That monetary history never disappeared. It was simply pushed into the background as paper systems took over. What has changed is silver's role in the modern economy. Unlike many traditional assets, silver is not sitting idle in vaults waiting for sentiment to shift. It is being consumed every day. Advanced electronics, renewable energy systems, medical technologies, and industrial manufacturing all rely on silver's unique conductive and antibacterial properties. No other metal offers the same combination of efficiency and reliability at scale. Once silver is used in these applications, much of it is lost forever, dispersed in ways that make recovery uneconomical. This creates a structural imbalance. Mining supply grows slowly, constrained by geology, regulation, and cost. New discoveries take years, sometimes decades, to develop into production. At the same time, industrial demand continues to expand as technology becomes more silver-intensive. Green energy initiatives alone require massive amounts of silver for solar panels and electrical infrastructure. As the world electrifies, silver consumption accelerates, not retreats. Unlike gold, which is primarily stored and recycled, silver is depleted. Above-ground inventories shrink quietly while attention remains focused elsewhere. Markets often misprice assets when their importance is misunderstood. Silver's price has historically been suppressed by its classification as an industrial metal rather than a monetary one. Yet its monetary characteristics never vanished. When investment demand returns, it competes with industrial demand for the same limited supply. This convergence is powerful. When confidence in financial systems weakens, people seek tangible stores of value. When technological growth accelerates, industries require more physical resources. Silver sits at the intersection of these two forces. Few assets face pressure from both sides simultaneously. This is why small shifts in demand can lead to outsized moves in price. Understanding this dynamic changes perspective. Silver is not just a speculative bet on markets. It is exposure to a fundamental imbalance. It represents participation in technological progress while maintaining a hedge against monetary instability. Those who recognize silver's dual nature see beyond short-term charts and focus on long-term scarcity, real-world utility, and the quiet tension building between finite supply and expanding global demand. The greatest investors in history were never comfortable when they made their most important decisions. They acted during moments of uncertainty, when information felt incomplete and emotions dominated the market. Confusion creates hesitation, and hesitation creates opportunity for those who understand how cycles work. When fear rises, prices disconnect from value, and assets are offered at discounts that only exist for those willing to think independently. Comfort, on the other hand, signals that opportunity has already passed, because comfort only appears after risk has been removed and reward has been reduced. Market panic is rarely rational. It is driven by headlines, narratives, and collective emotion rather than fundamentals. During these periods, people sell not because the asset has lost its long-term value, but because they want relief from uncertainty. This emotional selling transfers assets from impatient hands to patient ones. Every major wealth transfer has followed this pattern. The assets didn't disappear, ownership simply changed. Accumulation during chaos requires a different relationship with fear. Instead of avoiding it, successful investors study it. They recognize that fear compresses time horizons, forcing people to focus on the next headline instead of the next decade. By extending their time horizon, disciplined investors gain an advantage. They ask different questions, not what will happen tomorrow, but what is likely to matter years from now. This shift alone filters out most noise. The ability to accumulate when others panic comes from preparation. It is built long before the crisis arrives. It requires liquidity, education, and emotional control. Those who enter chaos without preparation become victims of volatility. Those who prepare in advance become beneficiaries of it. This preparation is not about predicting crashes. It is about assuming they will occur and structuring decisions accordingly. This mindset extends beyond financial markets. In business and life, moments of disruption create openings for those willing to move while others freeze. New leaders emerge when old systems fail. New ideas gain traction when old assumptions collapse. The same principle applies. Confusion clears space for progress. Buying during panic is not about bravado or recklessness. It is about recognizing that markets overshoot in both directions. Just as euphoria inflates prices beyond reason, fear pushes them below reality. Those who understand this dynamic do not celebrate chaos, but they do not fear it either. They remain grounded in fundamentals, guided by discipline rather than emotion, accumulating value quietly while the crowd seeks safety, knowing that when comfort returns, the window of opportunity will already be closing. Financial freedom begins with a shift in identity, not income. The difference between those who build lasting wealth and those who remain trapped in cycles of earning and spending is not how much they make, but how they think about ownership. Consumer thinking is reactive. It focuses on convenience, status, and short-term satisfaction. Owner thinking is intentional. It focuses on control, leverage, and long-term resilience. This mindset change quietly alters every decision that follows. Consumers ask how much something costs. Owners ask what it produces. Consumers trade time for money and then trade money for comfort. Owners trade effort for assets that continue working long after the effort is complete. One approach creates dependency, the other creates optionality. Over time, this difference compounds into freedom or frustration. Modern systems are designed to encourage consumption. Advertising fuels desire, easy credit removes friction, and social pressure normalizes debt. None of this is accidental. A consuming population is predictable and controllable. Ownership, however, introduces independence. When you own productive assets, you are less reliant on constant income, less vulnerable to disruptions, and less influenced by fear-based decisions. Owner thinking also changes how risk is perceived. Consumers avoid risk because loss feels personal and immediate. Owners manage risk because loss is understood as part of growth. They diversify, ensure, and structure decisions to survive mistakes. They don't eliminate risk, they distribute it. This allows them to act when opportunities appear, rather than freezing in uncertainty. This mindset extends beyond money. In careers, consumer thinkers wait to be chosen, promoted, or approved. Owner thinkers build skills, networks, and leverage that create options regardless of external validation. They invest in learning even when there is no immediate reward. They understand that control over outcomes comes from preparation, not permission. Shifting from consumer to owner does not require wealth. It requires awareness. It starts with questioning habits, understanding cash flow, and prioritizing assets over liabilities. Small decisions made consistently create structural change. Over time, ownership compounds, not just financially, but psychologically. Confidence grows from knowing that progress is being built beneath the surface. Financial freedom is not about escaping work. It is about choosing work. It is the ability to say no to bad opportunities and yes to meaningful ones. Owner thinking builds this capacity quietly, step by step, replacing dependence with discipline, impulse with intention, and short-term comfort with long-term control over time, energy, and direction. Volatility is often portrayed as danger, but for those who understand how systems behave under stress, it becomes a source of opportunity rather than fear. Price swings, market shocks, and sudden uncertainty do not create risk on their own. They reveal it. Volatility exposes weak structures, over-leveraged positions, and emotional decision-making. For the educated and prepared, this exposure is valuable because it creates clarity where comfort once hid reality. Most people are conditioned to fear movement. They associate stability with safety and change with threat. Yet stability in distorted systems is often an illusion maintained by constant intervention. When that intervention weakens, volatility appears. This moment feels chaotic to the unprepared, but it is simply the system expressing its true state. Those who understand this do not panic when prices move. They analyze why they are moving. Education transforms volatility from noise into information. Instead of reacting emotionally, disciplined individuals look for signals. They study liquidity, fundamentals, and long-term trends. They recognize that rapid price changes often reflect short-term fear rather than long-term value. This allows them to step in when others step back, not impulsively, but deliberately. Preparation is what separates opportunity from disaster. Volatility punishes those who are overextended, underinformed, or dependent on perfect conditions. It rewards those with flexibility, patience, and margin of safety. Having reserves, avoiding excessive leverage, and understanding one's own risk tolerance creates the freedom to act when others cannot. In this way, preparation turns uncertainty into advantage. This principle applies far beyond markets. In life and business, periods of disruption accelerate change. Skills that were optional become essential. Inefficiencies are exposed. New leaders emerge because they can adapt, while others cling to outdated models. Those who invest in learning before disruption arrives navigate volatility with confidence rather than confusion. Volatility also forces honesty. It removes illusions about competence, strategy, and resilience. When conditions are easy, mistakes are hidden. When conditions tighten, reality asserts itself. Those who embrace this feedback grow stronger. They refine strategies, strengthen foundations, and build systems that can withstand stress. For the prepared mind, volatility is not an enemy to be avoided, but a teacher to be studied. It sharpens judgment, rewards discipline, and creates entry points that only exist when fear dominates. Those who understand this do not seek chaos. But they are ready for it, standing steady while others retreat, using movement as momentum rather than resistance, and turning uncertainty into a catalyst for long-term progress and strength.